Good morning, good afternoon, depending which side of the country you are on. I'd like to welcome everyone to our August economic update, our monthly webinar series. Really excited to have everyone here. Thank you all for joining us and hopping on a call on this wonderful, beautiful August day. A happy summer to everyone as we're getting into the last few weeks of summer before schools come back. So I'm glad everyone had some time to come and join us today. I'm Charlie McQueen, President of McQueen Financial Advisors. Craig, you can roll over to the next slide, please. I'd like to thank you all for joining us here. Really excited. We have an incredible team. The team here, we consist of our investment advisory group, managing bond portfolios, alternative portfolios, really doing a lot of work in this high cash environment. I want to thank them for all their hard work and credit expertise. We also have our asset liability management team doing all of our ALM reporting, our interest rate risk reporting, core deposit studies, ALM validations. Really important in this day and age, given the structure of how we're seeing so much change. And then our third group is our valuations team. Really excited. I know some of them are on the call here today also, along with the other two groups, where we're valuing things, buying things, and mortgage servicing rights, all sorts of good things. So great group. We got the three groups here in the company that are all working hard and doing wonderful things. So I'm really proud to be part of this organization. With that, today it's really exciting. We have two incredible presenters here. We have Craig Cecilia, our Chief Investment Officer and Managing Director. Craig oversees our investment portfolios, now in excess of $10 billion. Has been in the industry a really long time and has done an amazing job on predicting interest rates, overall direction and time, which has really been helpful to our clients. Have done just an amazing job with the good long-term projections. Along and just as great as Craig is Dan Freelo. Dan's a senior consultant for us. Dan is out in our West Coast location in California. Really thrilled to have Dan here. Dan has a tremendous experience in all areas of business, specifically in our interest rate risk group. And Dan has amazing knowledge on how to manage institutions correctly and manage their interest rate risk correctly. So thank you both for joining us today. Just a couple administrative things before I hand it over. On your screen, if you move your mouse around, you'll see the Q&A at the bottom. It might be on the top, depends on your version. Click on it, enter your Q&A. I will interrupt the presenters if it's appropriate at the time they're talking or at the end of the presentation for the questions, and we'll get those answered. So please do that. Also, today's webinar is recorded, will be added to our YouTube channel. Also, reach out to your McQueen Financial Advisor and they can get the copy too also. So with that, off to the next page, I'd like to hand the presentation over to the awesome team here today.
Thank you, Charlie. I appreciate that. Adjective is awesome. You know, I don't know about myself, but I know Dan surely reflects that. Absolutely.
You're more of phenomenal and Dan's more of awesome. So I think that's the way we should put it.
Right. Well, thanks again, Charlie, and thank you for everybody that's attending the webinar. We really do appreciate it, and we value your relationships. And as Charlie had mentioned, you know, this webinar is to be helpful, to inform, and to help develop some thoughts of strategy. And so in order to accomplish that, you can't just listen to what we're regurgitating out to you. You got to have some questions answered. So along the way, please don't hesitate to either chat in a question, raise your hand, call Charlie on his cell phone. I'll put the number across the screen if you want. And Dan, it's great to be with you again, presenting as well. You're a great partner with us and our teammate. So I wanted to just kind of go through the economic update here and talk about the agenda. First, we're just going to do some overall high-level economic statistics. We'll talk about interest rates and then have some closing remarks about, you know, what we recommend or what we foresee and have some predictions on interest rate. And with no ado, we'll start off with, you know, the most current is the COVID update, which we're not going to spend a lot of time, but it's impacting everybody globally. So we felt it would be remiss not to talk about a little bit there. And as we look at from the health data here, we can see that today's dotted line here is looking at a resurgent in some variants that are coming out to us. And yeah, there is always going to be, quite frankly, more than one variant. There's several out there. There's going to be several more. And it certainly is going to impact as the numbers get transferred into mainstream media of how people are going to react. It's going to affect how we're doing business. And our expectations here is coming up. We're, slowly going back to school across the country, people refilling their offices, getting people sitting back at their desks. And, now that we have some resurgence of a variant, the Delta variant to be specific, that's starting to really take a little an effect on what everybody's predictions are going to be. It will actually cause people to rethink their plan. And there are some institutions that said, hey, we're coming back in September and pushed it to October. Some going to January. So I'm not coming back at all. So we need to talk about that. And just looking at this, you can see the predictions here from the health org is they're seeing spike levels are supposed to go up, but then they're also predicting them to come back down. And what's really interesting is looking at the effect of whether you're masked or unmasked. Yeah, and you can see how the red dotted line is showing a worst case scenario for infection rates. And this is actually daily deaths if people don't mask up. Now, that doesn't have to do with anything with vaccinations. It's strictly just masking and following CDC protocol. And then lastly, this is kind of hospital use. And we've seen in pockets around the country, Florida being a really hotbed in parts of it where occupancy rates are hitting the limits that they have. But ultimately, we want to make sure as we go through budget season coming up this fall, as we think about the cycle of our economy and how the impact of either controlled or uncontrolled virus can really impact us and be prepared for it. Dan, Charlie, anything you wanted to add on to this before we kind of move into some other good economic stuff?
Yeah, I think as many of us have tried to break away during the past couple of summer months and catch up from what we missed last summer, I think we're seeing some of that concern with the rise in the Delta variant. Just took a trip a few weeks ago and saw that at airports and kind of a destination place. But more of that. We'll talk about that in a little bit with some of the economic commentary that's coming up shortly.
Excellent. Yep. Thank you, Dan. So we've seen the K recovery. We've heard people talk about it. We just want to comment there is we do have the opinion that the economy is moving along quite well. Our last quarterly economic update, you can see that we had predictions, and we still have predictions of decent GDP, higher than we normally have had over the last decade for the second half of 2021 and into 22, as well as elevated inflation numbers as well. But what really is causing this inflationary information data is a little bit different than what's actually recovering. It's the whole supply issue. What we're seeing on the economy here is there's a lot of things going really well. And the obvious things that aren't is, the travel industry, the leisure industry, restaurants. They've made a heck of a comeback. And they still are. And it's looking like that GDP is actually going to continue to do well for the second half of the year. One important thing is to make sure to plan for it. And depending on what type of customers you have, look at your industries, to look at your customers and what industries they work in. That's where you got to kind of focus and target with respect to growth, but also where you got to really do some planning for monitoring for problematic loans as well. As we look at what's working is remote work is possible depending on the industry, analysts, technology, call centers. Call centers have been, going remote for a long period of time, as well as some lending functions, but those things are actually possible. The management of people sometimes is a little bit different than you would have to manage when you're in person, but for an overall look at what people have been doing for the last 18 months, it's been kind of working for a lot of company and a lot of people. One of the things that you look at now is in that budgeting season is costs. Do you have the reimbursement of people working at home? Can you reduce some of the fixed buildings and costs that we've been running with over a period of time? Our fee income really hasn't changed across several industries that are doing well in the post-pandemic party. And but it is also freeing up time, taking down the quality of bringing up the quality of life with limited drive times and stuff. So all in all, we're seeing across a lot of clients as well as friends and family that remote work is possible. That we continue to encourage whenever possible. Now, that doesn't mean it's a Goldilocks where everything's working, though, right, Dan? I think there's
Yeah,
some
no,
problems.
Yeah, Craig, I would agree. It's amazing how well certain industries and companies have adapted to the challenges last year, figuring out plans to work remote, managing their staff, their resources, their operations. And again, that is specific to certain industries. But now we're going to take a look at really the areas that are not doing so well or have not done so well. And that's really that bottom of that K signal of the industry. So, yep. And in terms of we've seen that before, certain industries that have been hit hardest last year, restaurants, travel, leisure, hotels, et cetera. Again, these are industries and workforces that could not work remote, relying on various supply chain partners to get their business done and so forth. And just some facts, the hotel industry, occupancy is about 70% at the end of July of this past month. That's still down over 6% from the same level in 2019. So while we are recovering, and again, from a perspective of 2019, that's pretty good, I thought. U.S. airline passenger travel, it's down 27%. In May of this year, as opposed to 2019. So the travel industry, airlines, again, still a bit of a road for recovery. And then here's an interesting fact for the restaurant industry. That's employee intensive. The average employee turnover for full service restaurants, it's over 100% in the last 12 months. 100% turnover in that industry. Now we kind of know why it's hard to get a good meal at our favorite restaurant. But these things are improving. And this graph that you're seeing now really shows a reflection of these industries, the ones that were hit hardest back during the pandemic, April 2020, and where they've recovered since then in June of this year, 2021. We're still seeing that lag. We see that leisure and hospitality, it's recovered, but we still got some room to make up. Education and health services as well. Now, the last job report did show some of that, but again, it's been a slower road for certain industries.
Yep, absolutely. So, and I think some of the industries that kind of tried to remain open, say the airline industries, and instead of using Groupon certificates, if you will, they lowered the costs for air flights. And we're seeing, and we'll talk about inflation, but we're seeing that slowly escalate is the cost of travel and the cost to stay at hotels, and we're seeing that translate into total CPI and inflationary numbers.
Right. And I think all of us need to realize that as these harder hit industries do open up more, it's still going to take some time for them to fine tune their operations. There are a lot of adjustments that have been made so far, especially in the airline industry, and that's going to continue.
Yeah. So just to mention briefly as I go on to the next slide here is there has been help, and there still continues to be help with the unemployment system and how they changed the dollar amounts with bonus unemployment benefits, extension of the limitation of the limits, most recently, the child credit that they're giving for people for 21 and 22. And there's also just some other normal means like food pantries that are just overwhelmed, as we all know. But one thing I always wanted to comment about with these programs is it does skew the interpretation of data that the world has normally relied upon. And a good example is that unemployment number. And, you know, what is affecting it now that's not typical of what has always been a system number reported without any of these other variables impacting it. So, you know, government is doing the right thing to try to help those in need, industries for stabilizing them, and overall total U.S. economy, but it does complicate things and how to interpret how well or how poor we're actually doing. Speaking of that, you know, we to think about the big buzzword now is supply chain disruptions, you know, chips, you know, not Frito-Lay, right? There are different types of chips that everybody really wants to get their hands on. Caused incredible inflation in the automotive sector right now. I think it was 41% year over year increase in new used vehicles that had come up. It's just amazing what's going on in that industry. But you know, there's a few things that have caused this, and why is it? Whether it's how can we extract and deliver and distribute all the raw materials out there in order to create the parts and the workers. You know, we've got to go back to that unemployment rate and that K recovery of who's working and who's not, and how do we get people to work in certain positions to help the supply industry. Shipping costs are still extremely high. I watched an interview with a guy from Walmart CEO, and it talked about the 400% increase in shipping items, and some of the items that they, or I should say the majority of their items that they get from China, and asked if it's going to impact their way of doing business and looking for a new supplier. And he said, no, it's what they have to do, but what they're going to continue to do, because they don't expect it to continue to last forever. So, but we've all been affected, as we all know, friends, families, businesses, and we're going to continue to see why things are happening, but we're actually going to look to see how we can adjust our behavior and going forward. Dan, speaking about autos, give us a couple of comments about the auto industry.
Sure. Well, what better industry example than to highlight some of the issues that Craig just mentioned, the supply chain disruptions, and the auto industry has been a big victim of that, I guess you would say. So, we know that we've heard about the chip shortages. Craig just mentioned that. Other parts that are required from, again, our global suppliers have all impacted the new vehicle inventory levels. And you can see that in the chart and that kind of that bold blue dotted or dash line that's hitting about a 47-day inventory level now. And that's extremely low. I mean, we didn't see that until back in 2011. So what does that translate to? Well, we know that vehicle pricing has risen. We've heard that over and over again for about the past 6 months. New vehicle pricing has risen just about 5.5% over the past 3 months. That's material, but I don't think anyone would be shocked at that. But used vehicle pricing is up over 20% in the last 3 months alone. That's right, 20%. And that's what a lot of our clients and those auto lenders out there are concerned about is, we're now lending on used vehicles that are reaching exorbitant loan to value, loan to collateral measures. But again, that is a shock from the supply chain disruptions that we've just been talking about. Now, we do know that some of this is starting to slow down. How long, how quickly the new vehicle inventory issues can get addressed, it's probably going to be sometime middle of next year before we see a cleaner path of new inventory coming in. But that's a big disruption, especially for those clients that rely on auto lending as a staple of their business.
Yeah, well said. And I actually threw my dart and it said, June 23rd of 2022, just so you know.
Yeah, there is, and it's not just the automotive industry in general, and we'll share a little comments later, but those individuals that bought their recreational toys lately, and they wanted to put, enhancements on it, some aftermarket parts. They cannot be found, or at least they're not available for a long waiting period. So again, the ripple effect of this type of supply chain issue is far and wide for a lot of industries. All right, going on to the stock market. So we know that the market performance has been really hitting new highs for really the last 8, 12 months. Most of this has been led primarily by technology companies, technology service companies, electronics, commercial services. Again, markets are reopening. I think companies reacting in a positive way or taking advantage of it. But again, I think part of that market performance is also skewed to those group of companies that were on that top half of the K signal that we talked about early on. And just looking at the S&P 500, past 12 months, 32% plus. The concern is the current price to earnings ratio hitting some extreme highs. I think it's probably only one time higher, and that was probably around the 2000 level. And Craig, correct me if that's that is wrong. But what's driving this? Well, again, recovery efforts, more positive earnings coming out of companies. And Charlie, I'll have you flip or Craig to the next slide. But what's driving some of the stock market performance? Well, we know that those people that have been able to reduce their expenses over the past year, working remote, not working at all, and having some extra money from different government programs to help them through the stimulus or help them through the pandemic, that's money that's been put into the market. Interesting fact from J.D. Power, over 10 million new online accounts were opened up at brokers last year alone, 2020. It's not including the first part of this year. That's money that people are opening the accounts, and many of them first-time investors, self-appointed investors. They're doing it themselves, and they're dabbling in the market. So again, we're seeing some of that recovery efforts taking shape in the stock market.
Yeah. And there's been a lot of increase in disposable income and those federal programs, Dan, like you mentioned, the unemployment money that was actually some people doing a lot of extra income with that, really helping them and being bored at home investing. It's just fascinating to see that all happen.
Yeah. And interesting note is that the companies, the big companies that offer online investing, the E-Trade, the Schwab and so forth, the volume of online activity has swelled so much that they've actually had some issues with the capacity, in the past quarter or so. So again, they're adjusting, even though they're seeing growth, they're adjusting to that new client behavior that they've seen.
All right. And close it out on the stock market. We put up here, well, we have both banks, credit unions on the call, and we want to really highlight the financial industry. And you can see how the market is really valuing the financial space. We're over the last, say, 10, actually longer than that, we'll call it 14, 15 years, we're almost at the peak of the valuation of the markets for bank stocks. We've had a little bit of sell-off as we've seen a little bit of a hangover taking place with respect to saying, well, wait a minute, what's going to replace my PPP income? And secondary, if rates do click up, how are we going to replace that mortgage fee income type thing? And then lastly, we're going to look at later is margins as they've declined as well. But all in all, if you look at earnings, they've been very well for banks and credit unions across the country over the last 18 months. And you can see that the market really does value them. So if you're a technical trader, I'm sure there's a range that you could make out of this thing and say it's within a band, and you can see where that band's going. But it's definitely an opportunity for people to be paying attention to. So kind of segueing over into housing, we find this interesting stat. And, what is our implication? What do you think about aging in place, Dan?
Yeah, well, people in general in the U.S., they're staying in their homes longer, more than 20 years now. It's up to a little over 25 years now, back in 2020. So, what are the implications of that? First of all, we know that when families do not move, they're looking at different opportunities, home improvements. Maybe their extended family is also staying close by, so that impacts those institutions in those markets. We certainly encourage our clients to identify that if that's impacting your particular market, if you're seeing that trend, people aging in place, so to speak. And that could certainly be a factor to look at the products and how you serve those members. Whether it's home improvement loans, they're staying put longer, multi-generational family units that you could tap into. But again, that's a trend that, again, from early 2000 is continued. I'm curious to see how the pandemic might have disrupted that, if at all, when we get a new measurement of this from Redfin.
That's a good point.
Interesting fact. So yeah, housing price index, okay, rising home prices across the country continue to fuel really some positive consumer confidence. I think the median existing home price for all homes hit just over 363,000 this past measurement. So that's the national median home price. We know that certain home prices, whether it's in the very expensive segment, have been selling extremely well. A lot of homes on the low end, again, the most affordable ones are selling well, but the problem is inventory. But again, home prices bode well and should continue to bode well for the consumer. So here's some takeaways from the housing market. Interestingly, asking prices for newly listed homes up 12% year over year. Median home sale price up 18% year over year. Active home listings for sale down 26%. That's that inventory issue that we just talked about. There's not enough inventory that's going to be fueling the demand for housing. And, for those of you that happen to have sold a home recently, 54% of the homes sold above asking price, up from 30% last year. And of course, the time on the market, much lower, 16 days versus 1 year ago. It's a seller's market. And again, there's positive to that when you're on the sell side, but of course, negative. Those buyers and the concerns that buyers are having is now reflected in the home sales to some degree. On the selling side, we know that new home sales have fallen about 19%, 14-month low. Existing home sales, while they're up year over year, we can see this pattern of slowing in the last couple of months and last couple of reads. Number one, lack of inventory, we just talked about. Number two, and I think this came out in a Fannie Mae survey last month, the percentage of buyers who think it's a good time to buy is at a record low. They are afraid of spending an exorbitant amount of money on a house that they might have had their eye on for a couple of months. They've been in so many bidding wars that they kind of get dejected and they pull away from the market. Now we are seeing, mortgage purchase applications kind of bounce around. They've risen last week. I think they're up slightly over the prior week, but probably refi applications are the bulk of the mortgage app activity that's coming in. So again, a slowdown in the home sales activity, mostly inventory driven and too high a pricing. Out here on the West Coast, I know it's shocking on how people can afford a new 3 or 4 bedroom single family house. And that's across the country now too, in many metropolitan areas. So.
Thank you, Dan. It's interesting to find that it's a great time to sell and a questionable, with a big question mark, whether it's a good time or bad time to buy right now, unless you're kind of downsizing or going to pay a lot of money for that downsized home.
I think everyone comes at it from a different perspective, but as you just pointed out, Craig, it's a great time to sell. But what are you going to do next? Do you have a second home if you're in that favorable position, or are you going to now be on the hunt for another home with the rest of this crowd that is bidding ferociously for that prime property. So two double-edged sword, right?
Absolutely. It's time to sell and move in with your kids, right? It's payback time.
I got to move them out first.
It's like that commercial, expired.
Yeah.
Sorry. So I want to kind of segue. Thank you, Dan. Very insightful on the housing market. We're going to segue into some employment and what's happening out there. And the first thing, instead of talking about the unemployment rate, I wanted to just briefly comment about the participation rate. And it kind of goes down to my comments, and actually just a way of thinking is what our data points are we relying upon to really get a good gauge of what's happening in the economy, and how reliable are they, and should we be looking at them in a slightly different way than we historically have. And the participation rate is one of them, because I do think that without a recovered participation rate, we're not going to get to a sustained job number that would cause the Fed to actually move off the low interest rates. So there's two different things going on right now: is full employment as well as inflation, and that employment number is being skewed right now. We've seen some nice recovery. It's doing well. If we get into kind of a little bit, actually I'll turn the page, is the JOLTS, or the job openings. It's the highest it's been right now in well, as far as we look back. We've got 10.1 million job openings out there. It's a new record. And we have 8.7 million people unemployed. So, and you kind of think there's, well, what's happening here? And I've read several opinions out there that really kind of put it nicely, of even though you're unemployed, there might not be a job that fits your skill set. We kind of went through that during the Great Recession as well, as people were moving out of certain markets into others to hit where there's jobs for their skill set. And so that's one of the things that we have going on here is one is jobs available, job openings without the skill set on the unemployment rolls. But then we also have the high unemployment numbers that are from the certain lower end of the cake recovery description as well. You know, people are hiring. There was actually 6.7 million people hired last month. That's a huge number. 6.7 million, right? The majority of it, though, is retail. As you can imagine, the post-pandemic party, people going back to work, retail reopening, unmasked, of course, government and manufacturing. All kind of makes sense. We can argue the government one, but manufacturing coming back, retail coming back. What's super interesting in this whole job world is the quit rate. You know, even though there was 6.7 million hired, there was 3.9 million people that quit, that said, hey, I'm out. I'm either going to do my own thing, work somewhere else, but that's a big number. So all in all, we have this record level of 10.1 job openings. And then to offset that, we do have some decent numbers. On Friday, the payroll Friday, it was 943,000 increase in payrolls. It's the most in a year. It was just a wonderful number. And of course, the market, sold off. Interest 10-year went up 10 basis points, and everybody reacted to that one data point, whatnot. So it's fascinating what's happening right now, but we got to make sure we take everything with a grain of salt and make sure we understand it. Unemployment rate, as we're looking here on this screen, is looking at the length of employment is interesting, 31.6 weeks. That's a long time. You kind of look back into just after the Great Recession, back into that 11, 12 timeframe, 10 years ago, we had that a little higher length of unemployment going on. But you can see that it's interesting. The pre-pandemic unemployment rate was 3.5%. and we're at 5.4% is where we're at. So we're getting on that path of recovery. That black dotted line is on the path to recovery. And also the underemployment rate at 9.2% is getting back to the path of recovery. We're starting to get there. But once again, there's a lot of people that have not participating, meaning they're unemployed, but not working, looking for work, not on unemployment payrolls, that have shifted and dropped out of the job market. And we need to get them back in there to help overall economy, so we don't have such a big dichotomy between the haves and have-nots.
Now,
Go ahead, Dan.
Interesting comments and points you just made. I think number one, the participation rate still being quite a bit off where we were pre-pandemic, and then the on the job openings and the number of jobs that quit. That kind of is a testament of the consumer knowing I have options out there. If I don't feel like I got to work right now, I can wait. There's every time they go out, they see job help wanted signs. And I think that's setting up, a perception that they can jump back in when they need to. Now, that's certainly one element. It's not all of it, but that's a factor that we're seeing in many areas.
Absolutely. Thank you, Dan. There's a question that came in from Sue about interest rates. Another economist is out there predicting the 10-year, where it's going to be by year end, as well as by year end 2022, which I will cover at the end, but since it's out there and so I don't forget to address your question, Sue, I do believe that we do have a low rate environment, that we should have a little bit of a trickling up of the 10-year before year end, as well as in 2022, as we see more governmental spending to help support what's going on in the economy, employment to return. The big variable for not only me, but everybody is, how many variants in the virus come back to stall the recoveries that we've been having. And if they do, if there's some others that come that become more problematic for our health or stuff, I would expect it to stay down low. But I think the 10-year, is going to trade between here and a 2%. I don't think the normal average between now and year end is going to be closer to 2. I think it's going to be closer to more like 1 3/8, somewhere in there, maybe 1.5. But because there's just too much unknown and too much, like I said, data that's not necessarily as reliable as it once had because of things that we haven't experienced before. And we'll talk a little bit more about rate projections at the end as well. Well, what we'd like to do is kind of segue over into kind of the consumer, talk about that because it affects every one of us on this call of what's going on here. I want to go in the right direction, and it'll always help.
There you go. Yeah. No, great segue into the consumer. Really, that's what's driving most of our business. We know that. And the numbers look great. If we look at the overall consumer confidence index, it's reaching a 17-month high, at 129.10. The current conditions gauge also at a little over 160. That's a new pandemic era high. So, what's driving this? Again, the last couple of months, I think there was a good feeling that the vaccinations were rolling out. We were getting this thing. We were tackling the problem. Companies were opening back up. Clear signs that maybe we're going to be successful in getting kids back to school in the fall, and plenty of jobs, as Craig just mentioned earlier. So great consumer confidence. We see a little bit of kind of a sideways in the last read. Again, people want to, I think there's, the end of some of the stimulus and unemployment benefits are coming up. So there might be a little bit of a pause. We might see this go a little bit of sideways again, but overall, the last few months, great recovery from the consumer's perspective. And again, we're still seeing that on some of the next slides here. If I have you turn.
Yep. Operator error coming your way, Dan.
Yep. Again, just interesting notes. This past year, what's been driving some demand. And I found this interesting that I think Charlie or Craig dug up a while back, but the things that increased odd, that's really probably a factor of the change in the consumer behavior, change in their work environment, working remote, retiring, just taking a step away from their work. But again, a new set of parameters that the consumer is looking at. Again, what's going to continue next year? Who knows? If we could identify what other demands are going to continue to go up, we'd all be geniuses if we jump into those particular markets. But interesting facts here.
Absolutely. You can throw me into the kitchen accessories of that. My purchase activity went up last year for a little bit more home cooking.
There you go.
Toys, kitchens, and play food. That's it right there.
Right.
Well, we know that, appliances, for those people that wanted new appliances last year when they were at home more often, they couldn't find them because of, again, those supply chain issues. And now we're seeing some of that come back on the inventory level, but new appliances, kitchens, absolutely. I think everyone's learned how to cook a little bit better this past year. But everyone, this has got to be one of Charlie and Craig's favorite slides, how people are spending their money, their dollars, and their time. And pretty amazing when you look at, these are big ticket items, boats, RVs, and RVs consist of all kinds of things, travel trailers to the full-fledged, huge motorhomes that are, $250,000 and up. But strong growth, over the past 12 months or year over year. And for the most part, the boating and RV industry experts expect this to continue in 2022. Maybe not as heated. They're going to see how this summer and people have got out and enjoyed their new toys. But again, one of the silver linings of the pandemic last year is, getting these out and parked in your garage or in your driveway. Again, some of the drawbacks of people who want to use them maybe found that they were in a huge crowd with other boaters and RV campers. So that was a challenge. And we've seen that this summer with national parks being filled up. People who are trying to get a spot in a RV park, they've been booked up for 9-12 months. So again, drawbacks that will finally, I think, start to settle down over the next year.
Yeah. And talking a little bit about the consumer and, how have they been able to afford all these new toys, with respect to inflation or, bike seats and doormats and all that kind of stuff. And looking at the household debt number is really interesting. It's the red dash line. We're up to just under 17 trillion in household debt, as debt still remains extremely affordable. People, as Dan mentioned earlier, people are confident in what's going on, even though we're, still have an elevated unemployment rate and, still have viruses coming around. People are confident. We've had a little bit of wage inflation. And when I was saying like last month that there was a lot of wage inflation, and I paused for a minute and I kind of looked at more data, and I'm changing my adjective. Are we allowed to do that? Change adjectives to say there's a little wage inflation. And that has really been one of the catalysts of disposable income. People's expenses are gone down a little bit because of the remote work habits that people have. We have extremely affordable debt where you don't have to really pay back much of anything, right? With these low interest rates and terms that people are terms that people go for. So, but that disposable income has grown to help drive expenditures, and which is also one of those drivers of inflation for overall consumption. And it's not necessarily the core consumption. It's the stuff that Dan was just talking about that might not necessarily be, core expenditures. So I don't think it's permanent, quite frankly. I think, as you can see, the little blip down on that disposable income, it dropped down along with the household debt to disposable income as well. We're going to see a little bit less of an acceleration of these numbers and kind of, still positive, but at a lower rate of increase is what we're expecting here. There still is. Go ahead, Dan. I'm sorry.
No, Craig, I'm sorry to interrupt.
Yeah.
Would you think this is an accurate statement, that disposable income number coming back down? Again, a lot of people have looked at this slide over, the many months we've shown it. And they think, okay, that's where all of this this increase in my deposit base is showing up on my balance sheet. And I believe that's accurate. But now that we're seeing this at a macro level, taking a step down, would you think that's going to start to show on the balance sheet funding side?
So to understand that question is, are we going to see our institutions need less funding? As I didn't understand
Oh,
that question, Dan.
I'm sorry. But with the downtick in disposable income that the
Okay.
graph shows, would our audience, could they translate that to, well, is that going to impact my deposit base?
Understood. Yeah, thank you. I
Better
apologize.
clarification.
Yeah, right. So one of the things that we do we have been advising over the last decade and a half is, what is a reasonable amount of liquidity for our clients to keep on hand, right? And of course, we all know the answer is it depends, right? In quotes, it depends. And everybody's balance sheet is different, and their contingency funding lines are different, and their just normal funding lines are different. But in general, I'm a believer that you need to be levered. Don't have the opportunity cost be 0 to 5%. Charlie might be a little bit more conservative than me, right? And be, somewhere in that 5 to 6%, 5 to 7%. But ultimately, regardless of where we're at, depending on that balance sheet, we do think it's prudent to have a little bit of extra cash on hand now because of the unknowns, because of the variables that are out there that are actually influencing our current data. It's not that we're going to have a liquidity crisis, in our opinion, at all like we did during the pandemic, but there is that potential for one, continued withdrawal, still confidence, still spending money, but remember, wage inflation may not necessarily be there, and the stock market might now go sideways. Well, where are they going to get the money is from their savings account, which is going to slowly but surely go down. And we've seen on balance sheets that trend, actually not going down, but it's kind of stabilizing now. So it is kind of impacting us a little bit in our thought process to make sure that we just don't get caught where we have to sell off something if rates had gone up and had a loss, but really look at our cash flows and make sure we have a little bit extra cash than we normally once have. Nothing immediate. It's more of a let's slowly build it up because we don't see any material changes for quite some time, quite frankly, Dan.
All right. No,
Yeah.
good. Thank you for sharing that observation.
Yeah, you bet. So speaking about more about the consumer, this is that, and I'm going to run through these next ones quickly for timing reasons, but we all know the money supply, 5 years of money growth in 1 year, as you can see in that right red shaded or yellow shaded area. Just a tremendous amount of liquidity that the Fed is putting in there and buying assets and throwing cash into the marketplace. Along that line is Dan, and your liquidity that's been growing on all of the balance sheets across the country is personal savings rate. And it's really interesting to look at this savings rate here. And why I say that is it's been in decline. Let's just take all the volatility out. And since 1975, right, for 45 years, it was in a decline, or actually 35 to up to 2010, the Great Recession, and then it started rising again. So the bottom was in June, July of 2005. We kind of turned through the big sell-off in the markets, and people are saying, whoa, institutions, individuals, everybody got caught with a lack of liquidity back in the Great Recession. And so you can see that savings rate, how it's incrementally gone up over the last 10 years, which has been a little bit of the surplus that we've had on our balance sheets along with what the Fed's been doing. But the most recent volatility, that's an apparition. I wouldn't get used to having, a savings rate that's north of 20% or something like that. 13% is last reported. It's kind of getting closer to normalcy. But it's interesting to think that, you got to really do something bad to realize what you need for protection, right? Let's go on now to looking at life expectancy. really brief here. We've had a little bit of fluctuation here. There's a lot of reasons that life expectancy has gone up. A lot of it's just clean, healthy living, right? Exercise. But it's humorous that the recession, which you look at every single one of these gray recessions, life expectancy has gone up. I think it's just a correlation because overall it's gone up, right? But recessions are good for us. Little bit of volatility, and you can see that life expectancy actually took a little bit of a dip, right? And it's gone back up. And I think from the 2021 numbers, where we see that the life expectancy did take a deliberate tick down, the majority of that had to do with, pandemic related numbers that factored in there. But what's really interesting to see here is that one of the things that have been problematic in our economy as a whole is the whole pension OPEB funding. And you look at this chart and you can say, all right, we got to pay people longer. And one of the big variables that has caused those problems out there. And I'm going to talk a little bit about that later on the funding side.
Yeah, well, we can't go through the economy and the consumer without at least touching on energy prices. And we know that oil has recovered, as shown on the top graph there. But more close to everyone's pocketbook is gasoline prices have been rising pretty substantially. So again, that's a factor of the economic recovery. But again, it does take some disposable income out of our wallet, especially this summer when everyone's out driving and enjoying the good times. But again, oil prices, we'll see what happens in the future.
Right on. Asset quality is doing well. Doesn't matter where you look. You can see the 90-day delinquency, even on student loans, they're down to 569. Home equities at 105. Auto loans have come back down a little bit, 435. Asset quality is really good. It's interesting to see what will happen over the next few years as CECL gets implemented and economic factors get factored in that are changing. But right now, it's really hard to find an institution that has asset quality problems right now.
And Craig, on that note, I think it was reported a couple of weeks ago, banks in the second quarter reported negative provisions, and credit unions as well, negative provisions in the second quarter that just came out. So they understand that the concerns with credit everyone thought about last year, it did not materialize, at least not yet. So it's been very good.
Right. From a credit perspective, I just wanted to throw up a chart about state tax collections. They're up. You can the jaggedness throughout all is just the timing of taxes when they're due. They just continue to rise. The point here is that tax collections in dollars, as well as the percentage of taxes actually collected that were billed, are way up. And that kind of goes down to the health of credit-related assets in our investment portfolios. Municipalities are being able to run their schools, do capital projects. They're doing well. The market's very healthy. We think there's value there as well. So going forward, I want to talk, and I'm going to speed through a little bit for spirit of time here, is inflation. And it's just huge. Dan, you did a great job talking about inflation and kind of that automotive and say some in the travel and leisure inflationary numbers. Energy up in this last component was up 23%. We mentioned lodging is up 21%. Used vehicles up 41, just huge amount of inflationary numbers that just recently came out. But we like to really focus in on those non-permanent core expenditures. And as they're coming down and where we need them to be. We don't want them below 2. For right now, frankly, I'd rather be above 2 than below 2 for spirit of growing our economy and having that growth. And as a company, we do expect to have elevated levels of inflation, maybe declining a little bit, but elevated levels of inflation for the remainder of the year, as well as having really good GDP growth. But that doesn't mean that is our signal that the Fed's going to be moving. It is not. It's not going to be permanently cemented in. It'll start to even moderate even more rolling into 2022. Historical yield, you can see where we're at, that whole volatility since 2007, smooth. We've had rates declining. It's hard to fight a trend. I do realize since we printed this on, how long ago did we print this on? August 5, so 6 days ago, we're up about 15 basis points since this was printed in 5 days, 6 days. So it's just tremendous to see how the volatility in the market is working and how every current economic indicator is telling somebody to, hey, we need to really change our tune on what our outlook is for growth and our balance sheet and inflation. But ultimately, GDP is doing well. You know, it's 6.5%. Boy, that's where if we had consistent GDP growth in that level for, call it a 4, 5, 6 quarters, well, then we were going to have a little bit to talk about with respect to having something anchored and having to actually start to do a taper type of move on the Fed's level. We do see that it is transitory on some of the inflation, as well as which is translating into gross domestic product. There's a lot of demand out there. We think it's going to be tapering off a little bit, as we do see that wage inflations will be moderated a little bit. Governmental spending, although it'll take a different shape and form, will not be so direct to where they can really boost them and keep up that demand out there. And then also supply chain issues will be being fixed as well. But ultimately, GDP is doing well. We expect elevated levels probably through mid first quarter of 2022, then it moderating down a little bit. Subject to change, of course, with respect to what's going on with the variants of the virus that seem to be very contagious. Isn't this very interesting, seeing today's curve versus the curve back at the end of 2012, beginning of 13, when we had the 10-year dip back then around a 170. We're at a 131 as of this Monday. We're a little bit higher from there. And what's interesting is just to say, and Charlie and I argue about this all the time, is I think this is an absolutely beautiful yield curve. Charlie does too as well, but he says, but with an asterisk, it's really low. And you kind of look at that spread between the 2-year and 10-year. As of this morning, it's about 112 basis points, a little different from the chart on Monday, or Tuesday, but it's about 112, and that's a decent spread there. It allows us to make money as an institution and price our assets appropriately. And it's also a sign to say, why is that 10-year so low? Right, the one in the mid to the 30s. That's because people aren't necessarily worried about inflation, right? So programs that we've had, I see we're running out of time. We know that the programs that are out there and what's taking place. Just to reiterate, we had the CARES Act at $2.2 trillion. We've had the Consolidated Appropriations Act, which is just under $1 billion. We had the American Rescue Plan at just under $2 trillion. We've got the infrastructure bill that's about $1 trillion, with $550 billion of that new money that's going to be spent over the next 5 years, as well as the asset purchase program, which is one of the programs that they're utilizing to manage interest rates and be accommodative. But ultimately, those programs are going to continue. And I want to just make mention to the Fed balance sheet and how they're really supporting it. They're up to where you say the blue line is the total assets of the Federal Reserve, right? Just over 7.5 trillion. I think it's 8.2. Total securities held outright, a little over $7 trillion. You see that jump. Wow. Amazing amount of liquidity that they're putting into the marketplace to support the markets, and we don't expect them to taper off anytime soon. The forward-looking markets are expecting the Fed not to move interest rates over the next 12 months. You can see starting on this chart, this is the implied rate at the bottom of the row. About June of 22, there's a slight opportunity for things to go up in July 22. This changes on a daily basis, but overall the market is expecting that rates should be unchanged for a long period of time, and I tend to agree with it. We'll do our predictions in 1 minute because we got to wrap up. We talked about margins. Let's talk about some predictions here.
Yeah, let's do a couple projections and we're gonna have to wrap up. I know a lot of people are dropping off for their 3 o'clock calls on the East Coast time. So yeah, let's do that quickly.
Right on. So the biggest question out there is, what's going on with tapering, what's going on with target interest rates? And our opinion is that tapering will happen prior to them making any move in interest rates. But the consumer still has some gas in their tank. We don't expect them to be moving and on tapering anytime soon. It could be that they start to talk and start to plan it out, which they already have been. But we really do need to have unemployment to come down before they taper, as well as GDP not to be so volatile and be known as being a constant number as opposed to being volatile. So we need things to settle down before they actually make deliberate actions. Interest rates, I do expect, as we do see these continued GDP inflated numbers and inflation numbers for the 10-year Treasury to drift back up, mid 1.5 to 1 3/4 wouldn't be surprising by year end, but not because the economy is overheated, just because we continue to have these high elevated numbers that will wane off coming in 2022. Dan, you want to do some closing points on their key takeaways there, young man?
Sure. Yeah. Well, thank you, Craig. Listen, I think everything that all of our audience, they can read the takeaway slides, but look at these economic indicators as you start planning 2022. A lot of good information out there to help you formulate a good, solid plan to start with. Know your local markets, and really, as people are returning to work, how can your institution help them? Develop a strategy, develops a service, whatever that can help them, and use your tools, ALM, to help plan a successful 2022. And really the last slide, the takeaways, base profitability on the last slide.
Okay.
Keep your deposits down, your deposit costs down, just hold steady on your loans. Have you go the other direction. There we go. Anyways, keep your loan rates steady. You don't want to be the total low loan rate in town. That's going to even hurt your margin more, your margin compression. So I think with that, utilize the expertise that McQueen and our team has to help work with the challenges that you're facing. And that's it. So thank you.
We do have one question I really think we'd like to answer here, and Craig got reached out here by Mark. I know the Fed keeps saying that inflation is not here to stay, that it's temporary. He has a hard time believing that, as with many others. What are your comments on that?
Yeah, thank you for the question, Mark. I really appreciate it. It's interesting. When I say that it's not going to be here forever, that doesn't mean that we're going to have deflation, right? That's not what we're saying. What we're saying is we're going to have expected inflation to continue through the end of this year into the first quarter, and then it's going to subside to go back to normal inflation. So which means that cost of your dozen eggs that have risen to now, they'll pretty much be close to where they will be 12 months from now. And if you get into kind of core items, as opposed to those volatile components of food and energy, we're going to be resetting. We will have good normal inflation starting in 22, going farther and closer to that, or probably, right around that 2%, and not to stay elevated at, say, a 4.5% or 5% continuously through time. But remember, inflation's good for our country and growth as we continue to add people, products, and services. We want a little, but not over too much.
All right, I appreciate that, Craig. And also related to that is, since you reached out to, instead of our Detroit team, our California team for the automotive projections, which I enjoyed, Dan did point out that used cars are up substantially in price. And one of the issues there is that won't always continue. When the chips come back into the market, the new cars will flow again, and we actually should see used car prices subside, which is a good chunk of that inflation right now. Well, first of all, I'd like to thank both Dan and Craig, both of you. Wonderful presentation. Really appreciate the insight. Some great takeaways here, some good activities. I think it's a great time to start thinking about the planning session, as you talked about here. and understanding your local markets and then getting ready for the return to work activities. I do think focusing on other sources of income is something we've been talking about quite a bit in our profitability discussions. I really agree with you guys and how important that is. And then using some good decisioning with your ALM system to come up with what's right. Use that to ensure that you're fully invested. We argue about how much to be invested, but being fully invested is key right now. And really want to thank you guys. Just to wrap things up here, coming up, we do have our next webinar will be coming up on September 20th. It'll go right down the path here that we talked about. It'll be on profitability. And then on October 5th, we roll into industry planning and budgeting and getting ready for budgeting for 2022. So we're going to have some more economic and some industry planning activities coming up then. Then November 10th, we do have an investment update. And then last but not least, December 15th, an M&A update. So with that, we'd like to thank all of you for your time. I hope everyone has a wonderful day. Thank you very much, Craig. Thank you, Dan.
You're
Thank
welcome.
you.
Have a great day, everybody.